Let us stand for the national anthem.
Stand and sing of Zambia, proud and free, land of wealth and joy in unity, victors in the struggle for the right. We won freedom's fight, oh, one, strong and free. Africa is our own motherland, fashioned with and blessed by those who blend. Let us, all our people, join as one, brothers under the sun, oh, one, strong and free. One land and one nation is our cry. Dignity and peace in Zambia's sky, like a noble eagle in its flight. Zambia, praise to thee, oh, one, strong and free. Praise be to God, praise be, bless our great Zambia, Zambia, Zambia. Remain we stand under the flag of our land. Zambia, praise to thee, oh, one, strong and free.
Thank you very much. We may remain standing as we have a prayer from Miss Milimo Monsanje, Communications Clerk.
Shall we pray? Our dear Heavenly Father, we pray that you would entrust us with the wealth that you have given unto us. Father God, we ask that you may guide us even as we begin the announcement of the policy decision. We ask and pray that you may be with us, continue with us, and end it with us, O Lord Jesus Christ. For you who has begun the works in us shall finish them. Thank you for inclining your ear into this prayer. Amen.
Thank you. We may be seated. Allow me to acknowledge the presence of the Governor, the Deputy Governors, members of the Monetary Policy Committee, members of the press, ladies and gentlemen, good morning. Welcome to our fourth and last monetary policy press briefing for this year. As you may already be aware, the Monetary Policy Committee held its meeting over a 2-day period from Monday up until yesterday, and this morning the Governor will be announcing the decision of the committee. We have on stage the Governor, who is accompanied by the Deputy Governor in charge of operations on Governor's right, and Deputy Governor in charge of administration, Mrs. Reka Muhango, on Governor's left. Next to Mrs. Muhango, we have Director Economics, Dr. Jonathan Chipili, and next to Deputy Governor in charge of operations, Dr. Chipimo, we have Director Bank Supervision, Mrs. Gladys Chiwele. I am your Director of Programs. My name is Besnat Mwanza. Without further ado, I will proceed to invite the Governor to address the media. Governor, sir.
Good morning, and thank you very much, Bessie. Welcome to you all to this media briefing, which is the third quarter MPC meeting statement. Let me in advance just wish you a Merry and prosperous Christmas and the New Year, since this will be the last time I think we'll be meeting this year. So, as has been pointed out, we were meeting yesterday and the day before. The presentation is in 13 parts, but they are short ones, don't be alarmed by that. Some of the slides, I'll just point to them and do not go into details, as this will also be made available to you as always on our website. So I'll start out with the decision of the Monetary Policy Committee, rather than bore you with the running through that and take more time. I'll just say it's as outlined in the slide there, on the slide. So the decision of the Monetary Policy Committee, the committee decided to maintain the policy rate at 9%. One might be wondering, why did the committee do this? I must state from the outset that the decision was either to raise or to maintain the policy rate. Why is that? Given where we are at 9% in terms of the policy rate, and where inflation is at 9.7, the last reading, we would be expected to make an adjustment or upward adjustment in the policy rate just to align it to that. But we didn't go that way, and we'll explain why we did not go that route. So we noted as a committee that the projected inflation continues to be in the downward direction, and it will eventually come to the target corridor by the first quarter of 2024. The other thing we noted is that the path this time around, compared to the path that we had looked at the last time we met, which was in August, is a bit elevated. Now, it's the factors behind this elevation, I think, that are important in determining which way we go in terms of the rate. So that it is coming down, very laudable, but that it is outside the policy target, I think you might say that, well, that's the reason why I should do that. So why is the inflation persisting to be above the corridor or the target corridor? What we note is that since the last meeting in August, there has been a lot of things going on, one of which was the much anticipated conclusion of the ECF arrangement with the IMF, which is the extended credit facility, where Zambia was granted some assistance in the form of ECF, which is the extended credit facility. Now, underlying this is the aspect of financial assurances. The financial assurances are coming in the form of debt restructuring efforts. The debt restructuring here is referring to the fact that as a country, we defaulted on our external obligations in 2020, as you are aware. So since then, our country is under debt distress. So Zambia signed on to this common framework under the G20, where we are expecting to get some relief. Now, for the IMF to grant us the program that we are seeking, it was important that they secure financial assurances from the creditors. So indeed, that happened, and on 31st August, the IMF was able to grant us the ECF arrangement, which comes with some financing of close to $1.4 billion. Already following that conclusion, the first installment was dispersed, and that helped, as you noted, and we'll speak to that as well, in moderating the pressures that we are facing in the foreign exchange market in particular. Now, this debt restructuring is very important, as if you cast your eyes back in the early 2000s to mid-2000, when we had the HIPC and MDR initiative, you will note that following us acceding to that relief, a lot of important things happened in our economy, and it is our expectation that this time around, once we get the debt restructuring, similar kind of positive developments will happen to our economy, in particular on the budget front. Already, whereas before the ECF, we were not accessing any balance of payment support or even in particular budget support. But since then, we have been able to get some budget support from some of the multilateral organizations. So what we are saying is that with that in mind, it is our expectation that inflation would also be affected positively through mainly the exchange rate and the budget, because the ECF that we have, 50% of that disbursement is for budget support, and the other 50% is to augment the reserves. Already also we have seen some market players coming into the market, but some are holding on until the final decision is made on debt restructuring. The other thing that we took into account as a committee is that growth of our economy continues to be sluggish. I think there are numbers to demonstrate that later in the presentation, but the fact of the matter is that we are not growing at the rate that we would all want to be growing. In fact, in 2020, as you saw, we even went into recession, but we are slowly building up. 3% growth, 3.2, 4, 4.1 is laudable, but not sufficient to really address the poverty levels that we see in our country. There are also some vulnerabilities that we note in the financial sector, although obviously many of the financial sector players are much better now than they were before. There are some who are still struggling in ensuring that they are playing the role that they are expected to play in the economy. So when we put all these together, it weighed towards us maintaining the policy rate. So that's the main thing, but I'll come back before I conclude to really lay out some of the issues more clearly. Now, having made that decision, obviously it comes from these other developments. So if you look at the global economy, for example, what we notice that the IMF this year in particular has revised downwards projections of the outlook. This is the first time in a very long time, if ever, that such a thing has happened, that at every review point it became necessary to adjust the outlook. As a matter of fact, people are referring to the current situation that we are in as a polycrisis situation, meaning that there are many crises going on at the same time. We had, for example, the COVID. It hasn't quite left us. There are still some lingering effects of that in many of our economies. Notably in this respect, in China, the issue is much, much more pronounced in that they have a zero policy towards any detection of COVID. It results in lockdowns, and that has adverse implications on the supply chains, and obviously that impacts adversely on other economies as well. We note also in the developed countries that inflation has been rising, and in responding to that, the central banks have been raising their policy rates. In so doing, it has raised interest rates, which generally would say that there is tightening of financial conditions. Now, that tightening of financial conditions has other implications for countries like ours, the emerging economies, even for developed countries as well, in that because of the sheer magnitude of these countries, there is this aspect that when interest rates go up, even if ours are rising here, there is always that aspect of going to where they perceive that the risks are lower. So you see that in that response, there is what we may term a reversal of capital flows, in particular portfolio flows. You recall that in some of our previous interaction, we did point out that, take for example in 2021, you had a very sharp appreciation of the exchange rate, largely driven by the fact that there were a number of players who came into our market to buy our securities, and in so doing, they brought in dollars. When converted, they augmented the supply of foreign exchange on the market, and that resulted in the exchange rate appreciating. But now a reverse flow is happening, that as maturities occur, some of those are not rolling them over. Importantly too, when the coupon payments on the bonds fall due, they are not reinvested in the market as was the case previously. So that is exerting pressure on economies such as ours through the foreign exchange market. So when we look at this, we see that the global economy, as you see on the right panel here on the slide, is projected to not grow very much. In fact, the last adjustment was over 2.2 percentage points, where growth was now projected at 2.7. But there is an expectation that in the coming period, in the following year, it will move back to 3.2. But still, uncertainty is there. So it's a fragile kind of growth that we are seeing. What underlies this also is the fact that whereas previously, I think we were sharing this table or at all our meetings, we saw, if you look at the second column from the right, these commodities that we are displaying here, you see that in the second quarter of this year, they had all gone up, except, of course, copper. Copper declined, the prices of copper. But if you look at all the others, they had some quite significantly gone up. Now, if you now go to the last column on that slide, which is reflecting the situation in the third quarter of 2022, you see that the reverse has happened. All of them have now come down. The copper included has continued to come down. And these are some of the things we are saying, that there are risks that are associated with these movements. They are not without impact. They have an impact on the economies in terms of revenue collection, in terms of export earnings, and that has an effect on our economy as well. Then further, when we look at some of other indicators in our economy here, we have been sharing with you for some time now the Stanbic Purchasing Managers Index, which simply shows that there is a line, that this line, 50-point line, that if the assessment is above the line, then is a signal that things are positive. But when it is in the other direction, below that line, is a sign that things are not okay. So this is what we are seeing here. You will note that in the previous quarter, we had pointed out that no, there is some positive developments in the domestic economy. But that was short-lived, because the following month, you see that we were back in the red, instead of the green. Now, further, when we look at what our own survey is doing here or showing, we see there too that performance of the domestic economy has slowed down. In particular, when we look at output, domestic sales, new orders, and capacity utilization, you see that these have come down. And we can show these in this web chart. The red, if you focus your attention on the red, that's what is representing the third quarter. So you see that some of those corners are within the other area periods, except for domestic sales, volume of service, volume of sales as well. So what that is showing is that the economic activity is projected to have slowed down, or is estimated to have slowed down. These are the voices of our stakeholders here who are in the business, who are saying what we are sharing with you here. When we move on to the outlook for the rest of the year, okay, we are in November now. When we look for the year as a whole, notwithstanding what we have seen there, is that there is some expected growth of the economy to 3%. That could very well change if something drastic happens before the end of the year. But where we are now, it is projected that it will close the year by growing by 3%. In 2024 and 2023, it is projected that it will grow by 4% in 2023 and 4.1% in 2024. That is conditioned upon a number of things happening before that time. So these are some of the things which we are monitoring along with others. Now, for now, what we are seeing as the drivers of that growth that we are talking about are the financial and insurance, information and communications, where you are, the communications part, wholesale and retail trade, mining and quarrying, agriculture, as well as education sectors. These are the ones which are positing that growth that we are seeing in the period ahead. Now, this growth is obviously conditioned on some risks not materializing. So some of the risks that we see that could bring growth down include tighter global financial conditions. As I pointed out, it's quite expensive now. We have moved from a situation where there were low interest rates in these advanced economies. Now interest rates are positive, and strongly so. Inflation is now also much higher. And as the central banks rein in that inflation, is creating other challenges we are facing as the emerging economies. So the other aspect is that for the countries that we are depending on Russia, Ukraine for food and energy, those are now much more expensive. Granted, there are some efforts, big efforts for that matter, to find alternatives to this, but it doesn't happen overnight. It takes some time for that to happen. The other thing we have noted is that, you see, particularly in the oil side, is that quite apart from the price of the commodity is the time it would take to get your supplies because of the logistic arrangements. When the sanctions were imposed, it meant that ships which were nearly docking, they could not dock because they are observing sanctions, and that has disruptive effect to the flows of fuel across the globe. And now, of course, you had the COP27. There are also concerns on the climate change and its effect, Zambia is not spared in that regard. We do see the Russia-Ukraine conflict obviously weighing in on these issues, but as we have said before, there is a silver lining here for some of these things, particularly on the agricultural front. Maybe this is where we could stand up and be counted to be able to produce some of the things that others want and we also need. There are, as indicated, lingering adverse effects of the COVID-19 pandemic. Yes, here we have lifted all these and it's very nice. We have reached the herd immunity. So if please among us here there's one who hasn't gotten vaccinated, take time to do that, because it has been demonstrated that those who are vaccinated, the impact of COVID when they have it is moderate. So please take advantage of the opportunity that is there to get vaccinated. I'm proud to say that as a bank, we are over, is it 93%? We are 93% vaccination. So we are urging the 7% of our colleagues to join the queue and also be vaccinated. So these are the factors which are playing on our economy, and that's graphical representation of what I said. Now, if we turn to inflation outlook next, you see that thankfully inflation has not been as aggressive as it has been in other countries, but that is still upper single digits is still a concern, because we need to bring it to the lower single digits. But we are mindful that if you rush that through, there are costs also that go with it. But at the moment, what we are saying is that inflation has been coming down. There are pressures now for it to move to double digit, but we think, as I explained earlier, that if the restructuring and the other attendant factors follow through, that will moderate our inflation. But for now, just to share with you, if you look, the first part of this table is representing quarterly averages of overall inflation, food inflation, and non-food inflation. And the lower part of the table is looking at the end periods, which is the end period of the quarter that we are looking at. So if you turn now your eyes to the first part of it, you see that in Q2, which is the unshaded part next to a shaded part, which is Q2 2020-22, you saw that overall inflation in Q2 was at 10.5%. In Q3, this came down to 9.9%. The components, then we dissect that. You look at food inflation in Q2 it was 12.8, and in Q3 that came down to 11.8. Similarly, non-food inflation, you might say, well, that's just a nudge, but it was in the downward direction. So all that is showing is that inflation was moving in the downward direction. Now, if you look at the end points, it's slightly different there, because we are looking at the end points, and this is what we are pointing out, that pressures are building up, and the exchange rate is a major driver of this change that we are seeing. So just to complete the story, look at overall inflation, whereas in Q2, at the end of that period, which would be June, it was 9.7, then Q3, which is September, it was 9.9, and you see the components as well moving up. So that's an indicator that some pressure is building up in the inflation side. Drilling a little bit further there, just to see what the components of that inflation, what explains those movements that we are talking about in short. We see that meat actually has been a major driver here, If you look at the chart on the left side of the screen, we see that the blue color there is reflecting the situation as it was in Q2. Then the orange or brown, depending on your color kind of sensitivity, is what is reflecting the Q3. So what you see obviously that there's the bar in Q3 is smaller than in Q2. That's what we are talking about. So you see that a number of those items listed there, they were showing a decline. One other thing we have observed is that there is what we have explained, the base effects. This time I think when we are looking solid fuels, which is essentially charcoal, the price increment was much smaller than was in the previous period. So that also is helping to bring inflation down. The right-hand side is just a graphical presentation or on a year-to-year basis, which is showing you what I've just explained. Going further with inflation, I think you might say, why do we keep on that? Well, that's our main focus as the Monetary Policy Committee. So we go into great detail to just explain or figure out what is going on. So here again, I'm just reiterating what I said earlier on, in that inflation is projected to continue in the downward trend, and by first quarter of 2024, it will be in the target range. Now, we keep also pointing this because there are other policy documents that you should look at or you have looked at. You note that the minister in his 2023 budget, his target was for us to bring inflation single digit this year and to bring it within the target range by end of the year 2023. So we are explaining this, that we are not taking this decision now because of these things that we are seeing. But having said that it's coming down, but there are important upside risks you must be aware of, and we must all be aware of that. If they materialize, they could actually push inflation a lot higher. What are these? One is the tight global financial conditions that I referred to earlier. Then the adverse impact of the Russia-Ukraine, it's affecting demand for certain commodities, including copper, because as you noted, if there is slower growth in global demand, it affects the uptake of the commodities that we export. And that has implications in terms of our export earnings, in terms of our revenue collections. And that has come through quite strongly in the past month especially. Then we are also saying that following the publication of the cost of service study for electricity, I think there has been a debate going on as to what will be made use of that study. And people are pointing out that this could lead to electricity tariff adjustments, and that we are just saying is something you should be aware of. It's nothing new, but it's important to be aware of that, and you plan accordingly, those who are able to plan. The other aspect is the higher domestic maize prices. Here, ordinarily, when this season hits, you characterize it as the lean season. Why? It's because of logistics. Even if you have maize across the country, to get it to the other parts where it's needed, it takes a lot of effort, and that costs money. Now, with the poor infrastructure that we have, that can add quite a bit in terms of cost. But more importantly, whereas we did have a surplus, be it lower than it was the previous season, other neighboring countries didn't have the same luck as we had. So obviously they are looking for grain and other food items, and in so doing, they will nudge the price of the commodities here. And that we are alerting you as stakeholders that this is something could happen if really people act out to do that. And of course, the COVID effects are also at play. Interest rates. This time around, what we see that interest rates actually were mixed. Firstly, when you look at the average commercial banks average lending rate and the 180-day deposit rate for amounts exceeding 20,000 kwacha, these remained broadly unchanged. For the lending rates, they were at 25.2% and the deposit at 7%. Clearly, at 25%, that's still quite elevated, and that's something also we take into account the vulnerabilities. Remember what I pointed out, if you move the policy rate, some of those rates will be affected, and that will create pressures of their own. Now, on the other hand, Treasury bills, they rose to 14.1% from 13.1% the previous period, and for bonds, the increase was slightly higher, and they are already fetching a lot higher. Now, this is what we are talking about. Look, 24% versus, say, 8% in the US, or 3%. Still, some will think the 24% is not high enough to compensate for the risks that our face coming to our market. So with those high yields, people will still want to invest somewhere else because they see more prospects. These are the challenges that we have when we are competing for capital, that it's not just the rate that they look at, there are a lot more other factors that go into that decision making. Then our policy rate here is linked to the interbank rate. This is what we try to influence. And what we are saying is that for this particular rate, yes, you see it stable in terms of numbers, but look at the picture, which is the one on the right-hand side of the screen, that's the green line. You can see the pressures that happen intra-period. So this is what we are saying, that colleagues Isaac here and the company, they are busy trying to make sure that that green line does not go out, and if it does go out, they have to bring it back into the corridor. So what we are saying here is that you can see the volatility there, which means resources are going in, coming out, going in, coming out. So our open market operations, that's what they are designed to do. So what we are saying in this particular period is that at the end of the period that we are looking at, it was in the corridor. But in between, there were these pressures that were managed. That's what we say, that it was kept within the corridor through those actions. So on the left side is what I was talking about, the nominal interest rates. So the average lending rate is the light blue. You can see that it's kind of fairly constant, but at a higher level. And that's what you have all been complaining, that no, they are very expensive. So this is, the idea is that the chart on the right should be speaking to the chart on the left. That's what we are trying to do in these monetary policy actions that we are talking about. But there are other factors which are at play in determining those, and those are the ones we have to use other tools in order to influence them. Now, domestic credit, this is an area now of come from interest rates, which obviously has a bearing on people's ability or capacity to borrow. Now, I just want you to focus on this chart on the right. the blue lines. The blue coloring there, the shading of blue, that represents credit to the private sector. So you can see when there's these complaints, we hear when people are saying that there's little credit going to the private sector. That's borne out by that. But what is the important point we are making here? The important point we are making here is that look at the last two bars on the chart there. You see that there is blue. But in the August rather, it was a bit bigger blue. But when you come to September, again, it came down. So what we are saying that there was some growth in credit. The red, that's the government claims, that's the holdings of government paper by other players. So that too, you can see it was coming down. And this is important because I think people have been saying if the government is borrowing too much, that means for the same amount of money, less will be left for the others. That's the crowding out issue that we talk about. So the government is controlling its borrowing by setting that target of domestic borrowing. So if it is followed, at least the players will know where they stand and be able to access credit. But of course, the cost is still an issue with the interest rates we talked about. So what we are saying is that this credit growth that we saw in this period was really driven to a large extent by the private sector. And the areas which these monies went to was increasing investments for capital goods in the manufacturing and mining. There are specific projects that we saw that pushed that credit up. Money supply. This, for some time, we have been saying that money supply has been a problem. It's not growing. This time around, we see some growth in the money supply, which is a growth of 13%, which is actually in a positive territory in terms of being real. So what you see here, if you look at this chart on the right, the blue line, that is showing you year-on-year growth rate of broad money. Then the red one is now the same but adjusted for exchange rate. That means we try to see if you removed the exchange rate effect, what will be the growth of this. Now, if it is depreciating, it means that in kwacha terms, it looks a lot, but in foreign currency terms, it will be less. The reverse is true. If it is appreciating, it will be low, but in kwacha terms, in dollar terms, it will be much higher. So this is something just to look whether the growth is not just because of the exchange rate movement, or there is something more to that. That's what that is trying to do. The other one is the one which is it gray, or that's quarter on quarter. So that you can see also is growing, but really we have been in better territories in all these cases previously. That would be important for supporting growth in the economy. The government securities market, I pointed out there that there was an increase in the yields on that. So here we are talking of the quantums, the subscription rates for government bonds and the treasury bills. We are saying that it moderated. You can see that for government bonds were 115% compared to 90% the previous period. For treasury bills, this was 71, slightly lower than what it was the previous one. Now, remember what I said earlier, that the non-resident players in this, some of them, once the maturities were occurred, they did not roll over. Also, those who are getting coupon from the bonds were not reinvesting that money. In fact, when we look at granular figures, we see that when we translate those maturities and the coupon payments, they are in excess of $130 million that presumably was invested somewhere. But it leaves a gap in our market here. Now, the stock of outstanding bills, indeed, when you see subscription rates going up, you should also expect that the stock would go up, and that's what happened in this. Then the non-resident holdings here, they represented 24.7%, which was higher than in the previous. This is the chart here. The blue at the bottom, that's what is representing non-residents. You know, they have been higher, now it has come down. You see that the top holder of government security remains the commercial banks, which is that grayish piece above. Then the commercial bank, the blue one, that's the pension funds, that light blue. And then the green one, that's what we hold in terms of government securities. As an institution, some of these, we use them for these operations that we undertake. So it's important also to stress here that holding of government securities is critical indicator of financial stability in the economy. What do we say that? We say that because when you hold as a financial institution government securities, in terms of risk weighting, that's assigned a weight of 0. Okay? So then that's why, if you have noted, we engage the government to ensure that they meet their obligations when these do fall due, because if they don't, they pose a risk to this market, which government actually relied a lot on when the default occurred in 2020. So it's a market that we need to nurture because it does help in meeting some of our requirements as an economy. Fiscal policy. Here, I think you have had the occasion to listen to the minister, to listen to the ST. All we are trying to point out here that there are some fiscal risks in that both revenue and the expenditure are under pressure. The revenue, our reliance on the copper has that negative implications. When the prices come down and the exports come down, it means that those who produce that commodity are not paying as much as they are expected. So this is very, very important. Expenditure also in this period was not as high as it could have been if there was debt service to be made. That's very important. The debt service we are making is only for multilateral and a few high priority projects. The others, they are in this standstill phase, which is awaiting the restructuring that I referred to earlier on. Now, in the medium term, we are saying that there are these risks that must be contended with. One has to do with the low copper prices. If that continues, we see that this week at least there has been some kind of movement in the upward direction. But will it hold? We hope that it holds and it continues to do so. But if it doesn't, then it spells some challenges on the fiscal side. But overall, what we are saying is that we need to continue to have fiscal discipline, because this is a very strong anchor for macroeconomic stability and sustainable growth. Turning to the external sector, we see a development which hasn't been there since 2018, where now our current account balance is in deficit. Look at the solid line in the graph there. You can see that this has been coming down, but we are expecting that it wouldn't cross that zero line. But what you see there now is that crossing into the negative territory, which means that the current account balance has gone into negative. Now, what are the factors explaining that? This is because exports, driven by copper again, did not do as well. What you see that exports actually declined by 19.3%. Now, if you compare the decline that happened on the import side, is smaller, 0.7%. So there is that imbalance which is being reflected in the current account balance. There were other things that happened in the balance of payments. One is that the services account deficit widened. That means when we look at the services we provide and the services others provide, we were in deficit again in that space. So now, on the gross international reserves, what we are saying is that there was a marginal increase in gross international reserves from the 3 billion that we reported at end June to the 3.1 billion in September. Now, ordinarily, you would expect that having that gone up be slightly, the import cover would be larger. It doesn't work that way because what is used to measure import cover is the prospective imports. So what we see is that during this period, the prospective imports were higher. You can see already there in the export and import comparison that the imports came down lower than the decline in exports. Now, one important thing also to bear in mind, although we are not showing it here, is that what is the nature of these imports? Interestingly, quite a big chunk of that is going into raw materials, capital goods, and intermediate goods. That means that you are creating the capacity for production in the period ahead. So to the extent that that materializes, that means it will compensate for that decline in the period ahead. So here what we are saying that reserves at 3.1 billion, but they cover 3.5 months of import compared to 3.7 months of import cover the previous period. The foreign exchange market, I think this is a topical area. Many questions have been raised. What we see is that in the quarter that we are looking previously, is that the kwacha actually had appreciated quite significantly, 6.6%. But this has changed already because of the pressures that I alluded to. Now, that appreciation of the exchange rate helped us be it from the immediate, but also from the lagged effects in the inflation outturn that we looked at. But now we are seeing that as at yesterday, for example, the kwacha had moved to 16.69 per US dollar. So these pressures which were lurking in the background continued, but supply also became a challenge. So for us to try and manage this situation, we had to look at what resources we have in the way of mineral royalty taxes and other taxes that we now receive or buy from the mining companies. So to deal with the volatility that would have otherwise happened for the quarter under review, we put back $333.5 million to deal with the volatility, also support importation of critical items such as energy, agriculture, and to some extent health issues. When we look year to date, actually the amount that we have put back into the economy, to the market, is 1.3 billion. Now, this is very important for you to appreciate, because we hear concern that because the bank now is getting the mineral royalty and the other taxes, it's starving the market. To the contrary, we are distributing that money to those who need. I think we have explained this point before, that whereas in the previous arrangement, there are those who are bankers to the mines and those who are non-bankers. Obviously, as a banker to one who is bringing in money, you are in a privileged position. But the others are in a needy situation. So the issue is then, if they need foreign exchange, can they access it from you? Then issues of risks come into play. You may be one of those they don't have a line with, and in that regard, they'll have the foreign exchange, but you will not have it. But if that is in our hands, we are able to see the entire market, and then we'll place those monies to those who need it the most, and nobody is discriminated, so to speak. So that's the underlying message behind that. So what you see on the right there is really the pressures which are emerging. You see the red line there is showing the Zambian kwacha versus the US. Then you look at the green, that's the Zambian kwacha versus the South African rand. Then in the blue, that's the Zambian kwacha and euro. Now you see that the Zambian kwacha and the dollar, or if you look at the top one, that's the kwacha versus the pound. Now recently you saw that pressure which was in the US, because the pound was almost coming 1-to-1. At one point it was 1-to-1 with the US dollar. So you can see that they are moving in the same direction. Conclusion. The MPC, just to reiterate, decided to maintain the policy rate at 9%. We arrived at this position after taking a very careful look on what is going on. There were only two options in our view. One was to raise the policy rate, the other was to maintain it. The third option of lowering wouldn't be feasible, because the policy rate is already below the inflation rate. So that's why it's off the table in this conversation. Now, what we saw through our projections is that inflation is still trending downwards, and it will come into the target range, but later than 2023, in 2024 first quarter. Now, we also are alive to the fact that there are other efforts which are going on, notably the discussions, negotiations on debt restructuring. So this is a very important development. Granted, for us, we are not happy at the pace this is going on, but to be quite honest, from our point of view, the position where we were, say, May, and where we are now is a lot better in terms of the direction that the economy can go. In May, even in August, we are still talking about getting ECF, but in August, end August, we got that. Now we are, in effect, engaging very intensely with the official creditor committee and the bond holders, the Euro bond holders. So our expectation is that this process should be concluded within the first half of this coming year. Now, if that doesn't happen, obviously it throws a number of things into risk area. So we will be observing this very closely to see what happens in and what are the factors behind non-conclusion of that. So this conversation is not over. It's intensifying, if anything. We also see that the economy is growing, but it's not growing at a rate that could bring about sustainable growth. We also see that in the financial sector, there are some vulnerabilities which, if not addressed or if we compounded them, they could create other challenges for the economy. So when we weighed these factors, we found that it was prudent for us to maintain the policy rate at 9%. I thank you. God bless.
Thank you very much, Governor, for that presentation. So there you have it. The MPR maintained at 9% for the fourth time. We are going to go into a session, question and answer session. We will take 3 questions at a time. The first 3 questions will be taken from the audience here, and the next 3 will be from our online audience. I note that most of our colleagues are actually following this proceeding through online channels. So if you have a question, we have a microphone that has been set up. Please walk through to the microphone. As always, state your name, the media institution you represent, and you can proceed to ask your question.
Good afternoon, Governor. My name is Cecilia Chiluba from Money FM. During the 2023 budget presentation, the Minister of Finance talked about the creation of domestic gold markets and support for artisanal miners. Is the central bank now open to becoming the securitization and facilitation body of domestic gold buying for players such as pension funds and private institutional and individual investors who seek to diversify their assets holding by including domestically mined gold on their portfolio while simultaneously creating an off-taker for artisanal gold miners? The next question is, during the last MPC meeting, we did see that offshore investors have been net selling bonds at high rates due to uncertainty over private creditor negotiations and global interest rate hiking. Does the central bank foresee an expected deal with our bondholders in Q1 of next year, leading to a return of offshore bond investors, or would the prevailing elevated global rate conditions keep them out? Thank you.
Thank you very much. Another question is from iWave Radio in Chingola, and Jimmy Kanasha is asking, could the projected drop in inflation rate be realized faster if the challenge in the mining sector is resolved in the quickest possible time? What other factors can be outlined that can help our country's inflation rate to drop to the lowest level? Governor, maybe you can take those 3 questions.
Thank you very much. As you indicated at the beginning, colleagues here who come in to help in answering some of these questions. First, let me thank Cecilia for her questions. I think the first question I'll ask DGO to shed more light on our gold purchase program. Then I'll ask Isaac to weigh in on the bonds issue, what is happening in the environment, and if there are any residual, we'll come back to that.
Thank you very much, Governor. I think on the first question from Cecilia, there appeared to be 2 parts of it. one seemed to be suggesting what role is there for pension funds and other players to invest in gold. And then the other in terms of the announced scheme in the budget to organize the gold sector more formally by the government so that this can add to national development. I think on the issue of gold securitization and what other role other institutions can play, I think from our perspective, what we have done is we have continued to purchase gold from the market. I think we've now purchased something like 1,400 kilograms of gold, and that comes to a value of about $82.8 million US. Obviously, we're currently purchasing that from a major copper mining, but of course, as you know, we were initially also purchasing some gold from Kasenseli before they closed. We obviously have now set up the mechanism by which we can purchase gold from the local economy, so that's the first point. The extent to which we can extend that to artisanal miners, of course, will depend on a couple of factors. One of them, of course, is the extent to which or how quickly the new framework for organizing small-scale miners actually takes place. I think you need to appreciate that for us to actually hold gold in our reserves, it needs to be purified to a certain level for it to be called bullion gold and to count in our reserves. And we want it in that form because at that level of purification, gold is easily tradable. We can easily convert it into dollars cash if we have a crisis and we need to use those funds. And so it's very important that gold is purified. So currently we are having gold purified through the Rand refinery, and they do have their own standards for the gold that they receive. So for us, it will really be to work with the government and the framework to get to a point where we have sufficiently organized a small-scale miner so they can provide gold, we can track where it's coming from, and then we are able to see whether we can have it refined and taken into our reserves. So there's still a lot of work in that framework being set up and organized, which has to take place before we come in really at the end as, if you like, the buyer. I wasn't too sure the link you were making with other pension funds, whether we have any real role in their ability to purchase gold. Because again, just as we are looking at purchasing gold, I assume some of these other institutions can look at purchasing gold as well. But obviously that will depend on the extent to which that makes sense as an investment tool for themselves. We, at this point, don't have any, if you like, a security or index which we would be issuing for people to invest in. In that sense, we are not considering anything like that. I think that was really what I can say on the gold.
Indeed, your observation about what is going on the government securities side is spot on, is correct. First of all, I think on the global scale, what you are seeing is that portfolio investors themselves, those that invest in financial assets, undergoing some sort of restructuring to try and capture the returns that are being created by the tightening monetary policy in the US and also in Europe. But for our country, we have this unique issue of debt restructuring, where we are also seeing a slowdown in foreign investor portfolio interest in the Zambian government securities. We believe that going forward, that once this has been resolved, we should be able to see them return, because then the debt trajectory will be in better shape. So what that means then is that the Zambian economy will be in better shape than what it currently is, because then investors will believe that they will be paid when their new debt comes due. So I think we are very confident and positive that once this is behind us, then we should be able to see the return of foreign investors. Of course, these guys don't come every week or every month, but they come in waves. So I believe that that's what's going to happen. For now, those two factors are making these foreign investors stay away from, not only from Zambian market, but from several other markets as well, emerging markets. I think if you look at what's happening in those markets, it's similar to Zambia. as well as the so-called frontier markets, in which Zambia also is part. So let me end there for now. Thanks.
Thank you very much. Jimmy Kanosha, online, raised on if something was to happen, positive was to happen in the mining, will that not help to bring inflation down? The short answer to your question is yes. Yes, it would. Why? Because if there is more exports of copper, even at reduced price, you can make up for the reduced price with more exports. Better yet, if the price is as high. Now, the important link for us is through the foreign exchange market, the exchange rate. So if there is increased supply of foreign exchange, that will help stabilize the kwacha, and in that way, it will have less push effect to inflation, and that is what is going to result in inflation coming down. Are there other factors? Yes, there are. You not us talking about getting this restructuring going. That helps also to tame the sentiments. The players, you see, there are two things which go on when you look at an economy. There are real factors, and then there are those which you are not so sure, which we group them in sentiments. It says, when you are looking, maybe the risks are much higher in this country. So that informs your decision making. Now, once some positive development happens, then people see that, oh, actually my fears were unfounded. So you adjust your expectations, and that gives you the courage or encouragement to invest or undertake some business. That's how it works. So what we observe in our economy, a number of times, the perceived risk is quite high. We see it even within our own selves. There is this perception that, for example, if I use the gender example, where people feel that maybe women are not good for credit. To the contrary, actually they are the best managers in that. But still, stereotyping still thinks the man is the one who can be a good for getting the loan. So we see these discriminations which are going on. So one of the things is that we want to even that playing field, so that that perceived risk is removed and the price things up accordingly. What are others? The financial tightening in these other countries, if that slows down as it is expected, that will help us attract, which is the question your colleague raised and Isaac responded to. So there are quite a number of factors that go into inflation. Remember, inflation is a price, so as such, it's affected by supply and demand factors. So on the supply, there are goods, there are financial products and services. So when we aggregate all these, that will form what is supply. On the demand side, there's you and I, there are companies, so they too, if they can get to produce more and export, like we have been saying, diversify export earnings, that will go a long way in stabilizing the market, and in so doing, that will positively affect inflation. I hope that addresses you. I think those are the questions we had.
Thank you very much, Governor. In the interest of time, I'll just pick one more question. The other questions, we'll probably answer them and share them through our online platforms. There are quite a number that have come through online, but we don't have enough time. There's a question from Jonas Kayambwe, and he's saying, what is the cause of low liquidity in the market? What would be the solution to the problem?
Yeah, the are a number of factors. One, I'll ask my colleagues also to jump in here. See, what happens is that, one, the credit we are talking about was low. The government is a big player in an economy. Now, if you look at what we are saying, that the expenditures were not up to target, and we saw, for example, in the period just past, there are resources which they were released, which were made available, but they did not find their way into the market. So that liquidity was sitting instead of being into the market to be used. That's one. Two, you see, people buying foreign exchange, they are taking away that kwacha and transforming it into foreign asset. Some are buying dollars and euro, not to use in the purchase, but really as a store of value, meaning that they put them aside. Now, we see with this uncertainty which has been surrounding the conclusion of these debt restructuring processes, you saw where I pointed out that the commercial banks are major holders of government security. So instead of them, some of them at least, going into the market, lending, they would rather put that money in government paper and wait and see what happens. So the government paper withdraws money in from the market. So these are some of the key drivers of liquidity. The risk appetite is another, which determines whether liquidity will move. But another important one is during the COVID arrangement, because of the challenges COVID pandemic posed, we had set up what we called the TMTR, Targeted Medium-Term Facility, refinancing facility. We had put out a 10 billion kwacha to support the market. This has run its course. So you can very well imagine that that quantum, or to some extent of that, is no longer being pushed into the economy. If anything now, there are repayments happening because it has been over a year. We had given a 1-year moratorium on repayment, but that year has gone by, so repayments are happening. So that is also contributing to the low liquidity in the market. Maybe you have additional ones, you can think of.
No, Governor, I think you've really covered them. I think the issue is probably just a question of how do you deal with it. And I think the issues you raised, first of all, on the fiscal, that you're getting consolidation is taking place, and that you're getting, spending focused on, areas like clearing arrears, which the Minister has talked about, dealing with things like social cash transfer, which are direct payments into the market, issues like CDF, if that gets going. I mean, the nature of government spending obviously can have a big impact on the liquidity which we see in the market. And so that trend which has begun of consolidation, discipline, is obviously going to be very helpful to that. The other issue, of course, is in what happens for us on inflation and really creating the base for lower lending rates so that the banks can begin to lend. And here, perhaps it's important really to stress that many of the issues which people were talking about, which were problematic for lending, inflation was high, the exchange rate was unstable. I think there's been measurable progress made in actually addressing those issues. And so our expectation really is that the commercial banks need to begin to start turning towards supporting business, building business, because the way the government budget is running, we can see the trajectory is to reduce the deficit, is to have less reliance on domestic borrowing. I mean, this year itself, we've seen the government will be borrowing much less than it had originally planned from the domestic market. So these things really should be forcing us all to begin to turn to individuals, businesses, and to try and support them for growth. The only other issue which I think we're going to try and support in terms of the credit area is the issue of the guarantee scheme, which we have committed to piloting, where we can perhaps try and focus to see how can we reduce the risk which the small-scale players face, so that hopefully they can access credit at a cheaper cost and perhaps with some financing depending on how that scheme is actually run. So I think those are the issues I would add.
You allow me to add on the list that DG has raised. I think one of the things which we are not taking full advantage of, right now, the goodwill for Zambia is at its highest. There are a lot of people who would actually want to be in our position, even though us who are in, we feel maybe we are not there. Now, what does that mean? What that means is actually we have to take advantage of this opportunity. There are a number of institutions, multilaterals, which are looking for investable places, the pipeline. So what we are encouraging the commercial banks, the microfinance institutions, is really to partner these so that they can get lines of credit which would mitigate some of the risks that are faced. Because when you share risk, then the cost of money can be reduced. So there is a lot of interest by outside players to partner, find business opportunities. So if you know any, encourage them, and we want to encourage our banks also to look out and get these. A number of players are looking to have a piece of the cake here because they think that Zambia at the point where it is well positioned to really grow and have huge investment. So these seminars, workshops which are going, they are all sharing those opportunities, and we will be failing if we don't raise those prospects here in our meetings, that we need to encourage each other. We also need to partners. In Zambia, we are not very good at working together. We want to work individually. And that way, the risk that we carry is very high. But if we think, would have been much better. So I leave it there. Thank you.
Thank you very much, Governor. We have run out of our time, so at this point we've come to the end of our briefing. We will share the PowerPoint presentation and the statement that the Governor has issued on our website. So please look out for those on our website. Until next time, thank you very much.